Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today Mena and I would like to talk about shadow equity. So really, this is a way of incentivizing employees to start thinking about your business as an owner, from an owner's mindset, from an entrepreneurial mindset, as opposed to an employee's mindset. And so the traditional way of arranging something like this is obviously sell a share of the business to them, and then they've got some skin in the game because they've got to stump up some cash for those shares, and you hopefully not only reward the value and work ethic and everything they bring to the business in the past, but you encourage them to continue to bring that value. The challenge though is it can become complex, and just like any relationship, business partnership, it can be complex as well. It's not only do you have, the work considerations and potential disagreements and those sorts of things, but then you have personalities involved and it makes it more complex. So today, what we wanted to do is talk about what are some alternative ways that you can try and achieve maybe not the same outcomes, but perhaps similar outcomes. So, Mina, perhaps we can start by talking about, some of the downfalls or pitfalls with selling shares and employees becoming equity owners.
When employees have equity, they have a level of control over the company. They tend to have voting rights. They tend to be involved in a lot of the decision making, empowers them to sort of veto decisions or sort of attract sort of future investors or future employees into the business. Now, owners really underestimate how messy that can get if they don't choose the right person. It's really like a relationship. If you don't know who you're getting in bed with, it can lead to a lot of surprises down the road. So you really need to make sure if you're really giving equity in a business, what does that look like? Are you giving equity with voting rights, for instance? Like in many companies or many company constitutions, as an example, there are different classes of shares that you can issue. So if you're giving just ordinary shares, then that basically gives them the same rights that you have in your own business. So you need to really question, should you really be giving, for example, a preference share or a share with no voting rights? So you don't run into these issues. Or you can use what we refer to as shadow equity, where you still remain in control and you don't need to consult with each and every one of your employees who have a share in the business. So, Stuart, maybe we should start by defining some of these terms.
Absolutely. And I think you've nailed the real shares option. I mean, that's the option that I think is probably most common, or at least most commonly thought about. And that's where obviously you're transferring ownership rights, you've got politics, all those sorts of potential issues. Of course, as Mina's touched on, depends on the class of share and whether you want to strike a preferred dividend rate, for example, for some shareholders. So there's ways to sort of manipulate it. But at the end of the day, you're getting into bed with someone else. The next option that you might have heard of is employee share ownership plans. And they're quite common, especially in larger companies. And essentially, how they tend to work is that employees get shares in the company that they either buy at a significant discount or they get it as part of their remuneration. Now, it doesn't have to work like that, but that's typically how it's structured. So you still have all the complexity and potential governance issues, although normally a share ownership plan is used for relatively small percentage ownership. So, you might have a handful of staff that you allocate shares to as part of their remuneration package, but we're not talking about sheep stations here. They're not going to own a huge percentage of the business. So in that way, you still retain quite a bit of control, but, it's reasonable for them to ask questions around the strength of the business, any risks associated with it, what dividends they might expect from receiving those shares, those sorts of things. So you still have to create a little bit of transparency there. And there's a few documents around a employee share ownership plan. So it's not perfectly simple nor costless to establish. The next option is phantom or shadow equity. And that's what we're here to talk about today. That's where there's no issue of shares or change of equity. So there's no ownership per se, but you make arrangements so that the individual that's subject to this sort of phantom equity situation enjoys a share of the profits. And then maybe one day, if you go and sell your business, they may also then enjoy a share of the capital proceeds associated with that. But they won't do that as a equity owner, a share owner. They'll do that through other mechanisms such as payment of bonuses. That's how you would distribute the profit share arrangement and so forth. And the last option is really just a straight profit share arrangement that typically in those sort of situations are linked to a bunch of measurable KPIs, and the business decides, okay, well, if you meet these KPIs, this is what your bonus looks like, or share of profit, I should say, and it might ratchet up or down depending on the outcomes produced by that individual. Okay, Mena, let's talk about how you might be able to structure some of these characteristics.
So the first is probably the simplest, but not always the cleanest way of doing it, and it's via a profit share, like Stuart alluded to before. So basically, a simple sort of equation where they'll get a percentage of the profit share, whether it be based on EBIT or net profit, and it's simple. Everyone feels it, everyone knows it. It's easy to read, and it's easily accountable for. However, the risk that comes with it is window dressing the P&L. It's very easy for people who are in control, for example, sales or certain expenditure, to, for example, bring forward sales or keep sales that are on account that might result in bad debt, or vice versa with expenses, and underestimate them or push the creditors out a little bit to just prove that there's a bit more of a profit in the business for a higher profit share. Another common one is around long-term incentive plans, and this is where basically an employee is entitled to shares in the business or profit in the business at a later date. So, for example, this can be 3 or 5 years down the track during their tenure. So, this is a really good way of keeping senior leaders involved in the business and wanting them to actually improve the business as a whole. Because if they're getting shares or profit in 3 to 5 years' time, it's in everyone's interest then to actually ensure the business is performing at its absolute best. The problem that most businesses face around long-term incentive plans is that the metrics can sometimes feel too complex or too intangible because it just feels so far away. So 3-year cycles tend to be the sort of the sweet spot for these types of arrangements. The third most common one is around milestone-based payments. Now, I gotta premise that there are different types, but these are the most 3 common types. So with the milestone-based payment, these are around sort of discrete wins or KPIs in the business. So things that you would sort of award to project leaders or operations managers, things like that, where targets chosen are measured directly towards a certain KPI in the business that levers you to improve your overall business performance. Now, this can sometimes create sort of an independency in the business. So one department might not be sort of working with another department because it might impact their ability to reach a certain milestone. So it can work well in certain instances, but in larger organizations, these milestone payments can sort of create a sort of us versus them mentality. So Stu, before we design anything or contemplate which approach to go down, how do we go about it?
Yeah, Mina, one of the challenges with implementing these sorts of arrangements is the transparency or perceived transparency that might be necessary in doing so. So, a business owner that has been used to making all the decisions and understanding the information and having a clear understanding of the business's profitability and growth metrics and all those sorts of things, all of a sudden starts to think, okay, I've got to start sharing this information. And will people think I'm making too much money or not enough money? What are they going to think? And it's really interesting. I think it's going to depend on the type of structure that you put forward, because the amount of information that you disclose and share for share ownership plan, employee share ownership plan, for instance, versus someone that's going to have a pretty substantial equity holding will vary dramatically, of course. But look, I think the best thing is to come with clean hands, is to run an open book. The thing that, from my perspective, is what you're trying to do is retain and motivate team members, key team members. And so what you don't want to do is overpromise, underdeliver. Nor what you want to do is not give the team member enough information so they can understand what they can and can't control, and then focus on the things that they can control and improve. So at a minimum, it's disclosing a full P&L. Now, you might only do that, annually, for instance, if it's an employee share ownership plan, or it might be quarterly or even more often than that, depending on the type of equity that you're sharing or offering to the individual. I think you certainly want to make it very clear of what the key drivers are, the key KPIs in the business, and particularly for those team members that aren't necessarily financially minded. You as a business owner have had to learn how to read a P&L or balance sheet. Hopefully your holistic accountant helps you with that as well. But for some people that might be their core competency might be marketing or sales or something like that, they might not have that ability to sort of look at that data and understand it. So one of the key things is to really help them understand it, help them read it, and help them identify what are these key levers in our business that we can pull to achieve better outcomes. But on the flip side, you don't want to share too much. You don't want to give them access necessarily to all your intellectual property, everything that you've worked hard for, your key relationships, these sorts of things. Now, it might be okay to share those things, particularly for someone that holds substantial equity in the business. But again, if it's just an employee share ownership plan, sometimes you can overshare. So at least you've certainly got to, come to terms with the fact that you're going to have to share this information wider. And just as a sidebar, really, I think, a lot of your team members will probably overestimate rather than underestimate the amount of money that you're making. So quite often, sometimes the reluctance for a business owner is, oh, look, I had a good year this year. And, the team members haven't seen the 10 really challenging years that led into that one good year. What are they going to think? Well, the reality is if you didn't share the information, they had a guess at how much money you're making, particularly people that haven't been in business and don't understand cost structures, they probably overestimate it anyway. So sharing the information can go a long way to sort of building that trust and rapport for those team members. Okay, every situation in terms of phantom equity, how you structure it is going to be different. We've mentioned a couple of different options already in today's episode, but Mena, maybe you can take us through some of those key elements.
So the first thing I would recommend is that to actually start low. Test the waters with your employees. Be conservative with a percentage or smaller pool. Now, sometimes the intention or obligation is to start with a higher amount just to keep the employee happy, to keep them invested in the business and make sure that they don't go anywhere. The problem with that is you don't see the fact that anyone can be replaced. And if that's the case, then you're in a world of trouble. There shouldn't be that key person risk in your business. So you need to start with that smaller percentage to allow sort of you to sort of test the waters, feel each other out, make sure that everyone's interest is the actual business and the business performance. Next thing to do is to actually set time boundaries. So there can't be, for example, any further equity released until for another sort of 24 to 36 months as an example. So it's not a sort of set and forget. So at 24 to 36 months as an example, you can then reassess how that relationship has been going, how that employee has been doing in the business and what they've been able to achieve. And then at that point in time, decide whether they are entitled to further equity in the business. The next design thing to do is to avoid rewarding one-off price rises or counting artifacts that might allude to a better profitability one year than the other. The problem with doing that is that you're basically giving them equity for just one piecemeal item that has resulted in a greater profit share in that year. So it's really important to lock adjustments upfront, understand what add backs you're going to be using in the business for the purposes of the valuation or the profit distribution. What one-offs are there? What abnormal items are there? And this doesn't only relate to expenses, but it should also relate to income particulars. And then finally, prevent any sort of obsession around metrics. So you need to add 1 to 2 guardrails, if not more, to ensure that there's no underlying effect to your business operations or your customer satisfaction. So things to ensure that quality, safety, customer churn, or even employee churn is not a cost to the business. So that all your goals are aligned in the actual business.
Yeah, so you can really design it any way that you'd like, but I think it's really about thinking through, both the positives and negatives. And also, whilst you can design these things so complex to protect you as the business owner or the majority business owner, sometimes you can do it to such an extent that you actually destroy the whole intent in the first place. So it's also it's very important to sort of return back to, well, what do you want to achieve from some sort of phantom equity? And ultimately, it's really about retention provision and reward for in most situations. The other bit of advice that Mena and I wanted to share is that it's really important to stress test an arrangement. So sometimes in business, we can become a little bit too short-term focused. And we think, oh, well, let's design something that works today. Full well knowing, we all know, and probably we should remind ourselves that, of course, if there's one thing that doesn't change in business, it's change itself. So whilst our industry, our cost structure, our client list, our team structure, all those sorts of things might be what it is today. Those things could change and could change quite substantially over the next period of time. Could be the next 3 years, 4 years, 5 years, those sorts of things. So it's good to stress test these arrangements. What happens if they do change? What happens if profitability or margins change significantly? What happens if you have an absolute killer of a year and you haven't capped, for example, the phantom equity or the profit share that you're willing to share with that team member or team members? What happens if you have a terrible year? In fact, what happens if it's a negative cash flow year where we've got to put money into the business? And again, if you're introducing equity owners into the structure, do they have to contribute that capital if it's necessary? So I think the best thing to do in those sorts of situations is go and speak to someone that's external from your business, be it your holistic accountant or advisor or someone else, because they're going to have the sort of clear separation from your business, and get them to stress test it and make sure it's going to work in any environments. Mina, before we wrap up, let's talk about, who is the right person in the business, and that's going to be different for every business, of course, to consider these arrangements for.
Now, I don't want to sound like a capitalist, but like I sort of alluded to before, everyone is somewhat replaceable. Now, it's the ones that you find that aren't replaceable that should be awarded equity. Now, these people should really be more than employees. They should be bringing something to your business that improves your business overall. They've contributed more than what a standard position description of that employee title would be. They're the ones that you sort of want to retain, of course, as long as they're sort of inclined with your values and you work well together and you're happy to keep them. Then these are the type of people that you should sort of involve in your business and make sure that they have a role or equity or shadow equity a role in your business. Now, handcuffs can work both ways. So even though you're handcuffing them to be involved in the business and you're retaining them, they're also retaining your involvement with them. So you need to make sure that the relationship works. You need to make sure that, you guys have actually had a tiff or two that you guys have been able to work through. You guys have been able to resolve disputes pretty well and had the business interests at heart at all times.
That's right, Mina. It's challenging to pick, the right moment, the right team members to introduce this to. And I guess if one thing today's episode has shown, that it's really the world is your oyster. There's so many ways that you can implement incentive plans. It's not just about selling equity. There's a lot of other things or structures that we can consider. It's just about knowing that they exist and then thinking about whether you should introduce them into your business, and then the timing around introducing into your business. It might not be now, but certainly at least it's something you can keep in the back of your head and have a clear picture on what does that team member look like that I would want to do this with. So hope that's been useful. It's probably created more questions than answers in your own head, but that's what we're here to do. So until next week, bye for now.